Greetings everyone, this is Houston Trong from thetradingedge.org, and this presentation is called Thriving in the Volatile World of Cryptocurrency Trading. 4 road rules to deal with the VUCA of cryptocurrencies. Now, if you haven't heard the term VUCA before, then just hang tight. I'm definitely going to get into the definition of that and the understanding of what VUCA means. But for the next about 40 minutes or so, my goal is to share with you some of my experiences, ideas, and some rules that have sort of helped me trade the crypto space successfully. And hopefully these road rules will help your crypto trading as well. So let's begin with just a bit of levity. So in 2018, what were those crypto expectations like, right? So if you recall, December 2018, when Bitcoin cracked the $20,000 mark, I think a lot of traders out there had Lamborghini dreams. And as that bear market unfolded, it went from Lambo dreams to flip-flop dreams. And by the end of December 2018, most crypto traders were no longer crypto traders. Now, fast forward to 2019, and boy, have we ever had a reversal. So December of 2018, now that looks like a sports car in December, but that's actually a toy car. So I think the expectations were pretty low in December of 2018, but the bear market actually ended, and price actually bottomed in January. So fast forward to June now, we've had quite the mirror reversal. Price is now cracked for Bitcoin anyways. It's cracked to 11,000, and a lot of these traders have moved from toy car dreams to yacht dreams. So just a bit about me and my crypto journey and where I started with cryptos. I've been trading cryptos now quite actively for the past 2 years, but got involved with Bitcoin specifically around circa 20, maybe I want to say early 2015. So I certainly heard about cryptos and specifically Bitcoin back in the early or mid, I guess you could say late 2013s, when Bitcoin basically went from zero all the way up to 1175. And then there was that really steep correction that took it way back down to close to 100. And so back around April of 2015, I drew a very simple trend line. Drew from the pivot high to the low there, just connecting the trend line, connecting the highs, and I decided to make a purchase of Bitcoin when that trend line broke. I put my stop at the bottom of the previous pivot down here, but the reality is that it was going to be kind of a binary trade. Either Bitcoin was going to go to zero or it was going to go higher. That was kind of the bet. So I risked the amount of money that I was comfortable losing, because it was basically a binary bet. It was either going to disappear completely, because no one knew at that time what was going to happen with Bitcoin after that huge rise to 1175. And no one could have guessed that it would have gone to where it is today, around 11,000. So put my order in there. I got filled around 250 was around that area that I got filled. And when I first picked up that Bitcoin, I had the intent of actually trading it more actively. But as you can see from that chart there, basically for about 18 months, Bitcoin went nowhere. So although my trade wasn't underwater, the ranges were so tight in Bitcoin that it wasn't even worthwhile trading it actively. So basically I just lost interest in Bitcoin for a number of years. And then you got to fast forward for about 2 years until about circa 2017, when price cracked the 4,000 mark, somewhere around there, that I got interested in Bitcoin again. Bitcoin and the crypto markets were resurging. There were now many other coins to trade, not just Bitcoin. There were a bunch of altcoins. And so when price cracked that 4,000, 5,000 mark, it definitely got it back on my radar, and I checked my wallets, and and I had a good portion of crypto, of Bitcoin, to now begin to trade with. So I traded actively the market on the way up. So from 5,000 up to the 20,000 mark, made some okay money on that uptrend, but made a lot better money on the downtrend. So as things came down, a lot of traders or a lot of those hodlers were stuck in those trades, and there was a really good short opportunities. In fact, cryptos then the Bitcoin market proceeded to correct about 80+%, and the ranges were very wide from the top of 2018 all the way down to mid 2019. So the ranges here were really exceptional, and there was the ability to go both short and long and make good money trading both sides. So I made really good money on the downside. Although at the end of this bear market, around late 2019, price got very tight. So as with many bear markets, when you have that bottoming process, you begin to see the ranges tighten as basically most traders have left the space because they're no longer interested in trading it anymore. And so then you get a lot of consolidation, and this is where I gave back a lot of the gains, because just how tight those markets were. Trying to be active and trading those tight markets was like trying to be active back here. It wasn't a good market to be trying to trade actively. So that's it's a good lesson for that I incorporated now into my trading. But since then, I'm back into Bitcoin. And I'll get into the trade that got me back into Bitcoin later on. But back into Bitcoin in these, the 4,000 level, and this chart's a little bit old now because Bitcoin's now trading up around here, 11,200 as we speak. So, just some quick year-to-date returns. So my crypto journey now. We've talked a bit about where Bitcoin's trading at. This slide is about, I want to say about 5 days old. So it's a little bit. It's a bit dated already because some of the returns have changed, but at the time when I created the slide, we had Litecoin leading the charge as pertains to the year-to-date returns. So year-to-date returns for Litecoin 300+%, Bitcoin 150+%. Compare that with the equities. Nasdaq is having a phenomenal year, up 22% already, and the S&P is having its best start of the year, or best year since 1997. So equities certainly are flying, but nowhere near what we're seeing with the cryptocurrency markets. At the bottom of the returns year to date are gold and commodities, as well as high yield junk bonds. So what I'm trying to show you here is that cryptocurrency, if you believe it's an asset class, you might want to consider that as a viable asset class for investment. So just as in any other asset class, you might want to begin to consider that, given the returns of cryptocurrencies and how they trade, and we'll get into some of those reasons shortly, but cryptocurrencies for the time being are definitely an asset class worth putting on your radar, even if you don't trade it. So let's quickly talk about the opportunities of crypto trading. And I, by no means, am trying to be a cheerleader of cryptos, but I'm sharing with you my experiences on why cryptos are such a great opportunity. And of course, there are some challenges we'll talk about in a few moments. But the opportunities of crypto are the following. Number one, it's a nascent market. So it's a very new market, and this means as an early adopter, you can get good at something very early on in the early stages. And this allows you to become competent at something that not a lot of other traders are currently involved in. Number two, it's volatile. So when there's volatility, there's a potential for large returns. So not only is it volatile because you don't want to have volatility if it's just chop and noise, but oftentimes the volatility can lead to large range expansion and trending. And in those two with those two traits, there's that really good potential to create large returns. Number three, they're difficult to value. Specifically, cryptocurrencies, they're difficult to value. How exactly do you value a cryptocurrency coin? It's not like comparing something like gold or oil that actually has a physical demand on it. And that there's a limited supply, and you could actually say, okay, there's actual demand that you can actually try to value. Cryptocurrencies, there is no inherent use case for them. So yes, they are good stores of value potentially, but it's very difficult to actually determine what that exact price should be. So when it's so difficult to compare, when the value is so difficult to ascertain, What most traders do, what most investors do, and all they can really do is to value it or to compare it against other similar assets. So what you see is that a lot of cryptocurrencies have very high correlations, as the best that a trader and investor can do is try to compare the value across the same type of asset. So people compare the value of Litecoin versus Bitcoin, or Bitcoin, or maybe something like Ethereum versus an EOS, or Ethereum versus some other digital app. And that's the way that people try to value these coins. So this means they're highly correlated. The benefit is that if you're right and you make bets on a few coins and you're right on the direction of it, then you're going to be right on all those bets. And if they start trending, that's when you can create some really large returns. Number 4, the market right now, because of the early stages, are still very inefficient. So you'll see a lot of mispricings and wide spreads, and where there's inefficiencies, there are opportunities. And next, they're less competitive. Because they're still nascent markets, you don't have a lot of institutional money yet, and institutional traders yet, trading cryptos, especially in the spot markets. So it's definitely less competitive as you have fewer professional traders trading in the space. And lastly, the markets are 24/7 by 365. What an amazing idea. So you're not going to find this in any other market out there, whether you're talking Forex, futures, or equities. Cryptos are the only market that trade 24 hours a day, 7 days a week, 365 days a year. So if you're looking for opportunities to trade based upon your time zone, that where maybe other markets may not be open, or certain days of the year where other markets may not be open, then the crypto space is always open for you. And this also means that sometimes it's actually easier to manage certain trades, because you're not going to get any gaps for the most part, unless there's liquidity issues. You're not going to get gaps going against you. So if some of those previous opportunities actually sound like challenges, then you'd be right. So every market, though, presents its unique set of challenges. However, there's a term that I think encapsulates the challenges of crypto trading very well, and that term is VUCA. So if you've never heard this term VUCA before, it stands for V, volatility, U, uncertainty, C, complexity, and A, ambiguity. And crypto has all those things in spades, right? That's the real crypto normal. So the crypto space certainly has all those traits. And so what I'm going to do in the next slide is talk about some of the drivers that are pushing these VUCA characteristics, and some of the effects of VUCA in the crypto trading space. So first off, V, volatility. What are some of the drivers of volatility? Well, number 1 is very nascent, as we talked about already. Number 2, the rate and speed of change in the crypto space is phenomenal. There's always things that are new. There's always news that's coming out, and that causes things to get revalued very quickly. And third, just because of the rate and speed of the change, there's also just the dynamics of change. As things roll out, as things progress with the evolution of cryptos, it creates for a lot of volatility. So the effects are that the crypto markets are hence hard to value, because this perceived lack of stability and predictability. And so the effect primarily is that you get these very large ranges and potentially a lot of noise. U, uncertainty. What are some of the drivers? Well, as I said already, it's the rapid advancement in technology. There's constantly new blockchains technologies rolling out. There's constantly new coins being pushed out. The second part is that there is still the big overhang of potential regulations. No one knows when that shoe's going to drop, right? Whether it's the SEC that comes in and says that many of these tokens and coins should be considered securities, or whether or not the Federal Trade Commission says that that this thing needs to be more. Maybe KYC laws and all these types of things can potentially create a lot of additional regulations and regulatory requirements for the whole space. And finally, there's a lot of unknown counterparty risk. We're going to talk about this idea shortly, but this counterparty risk extends to not only the exchanges but also the individual coins themselves, and whether or not the actual coins themselves hold the assets they claim to have. So the effects of there's a lack of long-term insight. It's very difficult to know what's going to happen in this space. This leads to unpredictability. And thirdly, the effect is that for traders, there's potential for lots of surprises. Easy for there to be big shifts in sentiment and direction. C, complexity. The complexity comes from those new technologies, right? So you have to be a real unique technologist to be able to understand the intersection of all the technologies that comprise cryptocurrencies. There's obviously the blockchain technology, but there's also the cryptocurrency space. There's also the networking effects. There's game theory. There's a lot of things that are in play as pertains to the crypto technology. Secondly, it's a brand new paradigm. So I think most of us are used to and have grown up in this fiat currency space where the dominant currencies have been fiat currencies. Now we're talking about a brand new type of monetary currency that does not involve any state-owned actors. In some cases, like Bitcoin, it's completely decentralized and not owned or operated by any state-owned or controlled actors. So some of the effects are that because of the new technologies, they're very new still, that the actual solutions have been slow to come to market. There's been a lot of discussion and hype around the potential solutions that could come off the blockchain, but as we speak, 2019, there hasn't really been that many meaningful solutions to some of the promises that the blockchains have been making. Secondly, because of the early stages, there has been a lot of unproductive allocation of capital towards a lot of these blockchain projects. A lot of VCs have spent a lot of money investing in some of these technologies. Investors themselves and traders themselves have invested in some of these coins, tokens, and ICOs. And if we look at 2017 and the ICO market, most of those ICOs failed. So you can definitely say that there was a unproductive use of capital there. And the effect is that, and lastly, because of it's the brand new paradigm, just for traders, we see a lot of poor trading interfaces. These new exchanges are not antiquated, they're brand new, but because they're so new, they're just lacking a lot of features that many seasoned traders would expect to find. Things like robust open-close orders or OCO orders. A lot of these platforms, you actually have to code that in yourself, meaning you actually have to, write a software or script that plugs into an exchange's API to be able to do your order routing and management. And most traders don't want or have the means to do that kind of stuff, which creates the complexity. And fourthly, the A is for ambiguity, that hype versus reality, and the general misrepresentation of the technologies in the space. So there's been a lot of hype around what the cryptos are going to be able to do and what they were going to displace, but right now we haven't seen a lot of that. It's still in the very, very early stages, and we have to begin to counterbalance the promises from the actual delivery. And the misrepresentation is, there's still a lot of the actors in the space. They create fear, uncertainty, and doubt, and this creates a lot of doubt and distrust in the investor and trader class. No one knows exactly who to believe, which technologies are ultimately going to be the winners, and this really creates a barrier to adoption. A lot of money and users are sitting on the sidelines waiting there to be some sort of leadership, for there to be a quote-unquote winner in the race, so people can more clearly invest in the leading technologies. And lastly, because of the flip-flop nature of some of these of some of the technologies, some days it looks like one is leading, another day it looks like the other is leading. It leads to a lot of lapses in decision making. Traders will invest in one technology just to realize shortly after that they've picked the wrong horse. So very easy, because of the ambiguous nature of the technologies, to choose the wrong investment. So let's now talk about how to deal with these VUCA problems. So as with all VUCA challenges, really the goal is to move from left to right. We want to be able to shift from volatility to vision, from uncertainty of the problem to understanding, from complexity to clarity, and from ambiguity to agility. And so what I've tried to do with the presentation is to create 4 road rules that map back to these 4 solutions. So I have a road rule for each one of the solutions on the right, from vision, understanding, clarity, and agility. And in a few moments, I'll share with you what those road rules are and some understandings around each one of those road rules. So, solution number 1, moving from volatility to vision. The first rule is know the landscape. So the way that we begin to achieve vision is by first creating knowledge or understanding. And the first part of rule 1 is to know your exchange. Now, I'm sure all of us have heard about the history of failed exchanges. Of course, it really one of the most well-known exchanges to first close was Mt. Gox. This is probably about 5 years ago now, and that was one of the first major exchanges that shut down due to mismanagement, where a lot of investors lost their money. More close to home for Canadians, there's one late last year in October of 2018 called Maple Change that shut down and went out of business, causing investors to lose most of their funds. And of course, the one that's in the media now is Quadriga, where the owner of that particular exchange has been now found to have commingled the funds and unfortunately mismanaged a lot of the user funds and commingled it with his own personal accounts, thereby causing substantial losses to those investors there. He unfortunately passed away as well, which makes it very difficult to now recoup any of those losses. So the number one thing here is that you first have to know your exchange before you actually invest or trade cryptocurrencies. You need to do a little bit of due diligence and to understand who you're doing business with. What exchange are you trading on? Because a recent stat came out from ARK Investment Management that showed that for the past 10 years, there's been about 50 exchanges that have shut down. And the typical lifespan of each of those exchanges was about 18 months. So it just goes to show you, because of the nascent nature of the industry, we still have a lot of weak exchanges out there, and it's not uncommon for some of the exchanges to shut down in a short period of time, causing substantial losses to their investors. Just in 2019 alone, we have 8 year to date. So again, as part of the vision, rule number 1, you want to do due diligence on where you're putting your money. So either A, spread your money or your cryptos across various exchanges, and or B, keep as little money as possible on the exchange, thereby limiting the potential downside and keeping just enough money for you to trade or invest on that exchange. Of course, there's other solutions nowadays, but I'm not going to get a chance to get into all the details. Things like decentralized exchanges, where you can keep some of that money in your own local wallet, cold storage form. But again, the rule is still there. The second part of rule number 1, take security seriously. Now, I'm not going to have a chance today to get into how to secure your cryptocurrencies, but do take this advice seriously. It's very well known that there is no recovery mechanism if you lose your cryptocurrencies due to hacking or some sort of mismanagement on your own personal part. So if you lose your cryptos, you lose your cryptos. There's no way to get that back. There is no central authority who can refund you. So this means you have to take control of your own security, and this means spending a bit of time to understand where you're putting your money and other options in case you want to take your money offline and onto cold storage. Part 3, understand your counterparty risk. Part of that was mentioned already. It's understanding who your exchange is and understanding who they do business with. But the other part is actually understanding what assets you're actually holding. So what crypto assets and how they're being denominated. So if you're holding a crypto asset that's denominated in some sort of stable coin, like a Tether or some other stable coin like that, you sort of need to know what is the assets that stable coin is holding in the banking relationship that stable coin has. Because worst comes to worst, if the stable coin you're dealing with or that you're holding or that your assets are denominated in, if they have if their relationship with their bank gets severed, then the ability for that stable coin to now access their underlying assets becomes very compromised, and you may or may not be able to cash out on that particular asset. So just be very well aware of that. And the last part of rule number 1 is just to understand the cryptos you're trading. Now, certainly this is very good advice if you're going to be investing for the long term. Then you want to take some more time and get to know the coins that you actually want to invest in. This means, reading the white papers. The white papers are usually, yes, they're a bit technical, but not overly. You don't have to necessarily understand all the technical aspects of it, but you certainly need to know a good understanding of what they're trying to do with that coin or that blockchain technology. And the second part is, from a trading perspective, you want to spend some time and understand the actual crypto you're trading. So things like, can you trade it on margin? What's the float of that particular cryptocurrency? What are the ranges like? What's the correlations like with other coins? Things of that nature. So know the coin you're trading. Let's now move on to rule number 2. So here we're talking about moving from uncertainty to understanding. And the way we begin to get some understanding is by having rule number 2. And that rule is, do not chase. Just say no to FOMO. So unfortunately, or fortunately, the cryptocurrency space is filled with traders who want to get rich quick. They're chasing price. So here's the funny thing, and I'll give you an illustration. Have you ever looked at a chart and said, this chart looks so good? Now, this is a chart of Bitcoin on the weekly time frame going back to December 2018. Now, this is the second week of December, and look at that nice chart, all right? It's going up from the left side to the right side of the chart. That week alone, in December, the second week of December, Bitcoin was up over $4,900, and it was up 33% on the week. Okay, now, we now know what happens, right? So what happens when the charts look so good? Well, the charts always look best before they don't. Let me say that again. The charts always look best before they don't. They always look like that. Okay? And so we now know what happened. The week after, Bitcoin dropped 9,191 points and was down 46%. So anyone who bought that high the week prior was now underwater. And of course, we know how that story played out. It ended up dropping over 80% to those lows that got hit in January. So the funny thing is that a lot of people want to somehow believe that cryptos are a unique market, and they're not. Sure, the technology is new, but the game of speculation is the same. So let me say that again. Yes, the technologies are new as it pertains to the blockchain, but the game of speculation is not. The game is still the same. The game is you are trading against other traders. I'll say it again. You are trading against other traders. So in a sense, the crypto trading space is basically a modern take on Keynes's beauty contest. So what are we doing in the crypto trading space? It's third order thinking. What does that mean? Well, it should be first order thinking, right? So in trading, we're no longer trying to pick what we think are the best coins to buy based on some sort of idea of fair value, okay? Because that would just be first order thinking. We're not even necessarily trying to pick the coins that we think everyone else likes, because that would just be second order thinking. What we're actually doing today is we're picking the coins that we think everyone else thinks are the coins that everyone else likes. So this is third order thinking. Have you ever noticed in cryptos, and that this pertains to any marketplace, that we're constantly trying to outguess one another, right? So what we're trying to do is we're trying to front run the other trader and go where we think where other traders want to go before they get there. So in a way, we're trying to front run and get there before everyone else does, so we can get the best price. Because if you're just chasing price, then you're late to the game. Again, the game is this, right? The game is that you're trading against other traders. So if you're inclined to chase, then what you're trying to do is that you're trying to look for a greater fool. If you're buying at a high price, this means you have to believe that there's someone else who's a greater fool than you, who's willing to buy at a higher price than you, so that you can get out of your trade. Just like in poker, you have to ask yourself, if you can't tell who the sucker is, you're probably the sucker, as Paul Newman famously said. So the key is, with this rule, which is to not chase, is to recognize your FOMO. If you find yourself looking too hard for a trade, then it's likely a poor opportunity. And that's the understanding that many traders have to begin to internalize. The good trades, provided that you have a good method with an edge, and that you're properly observing the market, just begin to reveal themselves. Anytime you become afraid that you're about to miss a really, really good trade, that's when you get impulsive. And I would challenge you to go back and encourage you to go back, go through all your records, and look at your impulsive trades. I know when I've done this myself, I can tell you that my impulsive trades have a poor track record. So let me give you a few examples now of what it looks like to chase. So this is a recent chart dated back to April. And what we're looking at here is that long consolidation period that we saw earlier in the monthly chart, but I've drawn it now on the daily chart. So in that blue box at the bottom there was that long consolidation period that began in mid-December or early December that extended all the way until we had that breakout in April. Now in April, we finally got that breakout. It took Bitcoin from about 4,200 here, right on that level there, and popped it up over 5,000. And so I was advising people who watch my weekly market videos and who listen to my blog to not chase this move. So here's what happens. So it pops up, and we can draw a simple trend line here because that's the recent high. Now, if you elect to buy this high, you're chasing. So here is an inside bar. Momentum traders like to use inside bars to get a good risk to reward profile. They'll buy this inside bar to the upside and perhaps put their stop either there or there. Let's see what happens on this example. They're buying the breakout. They're chasing price. Okay? As soon as they buy, it moves up a little bit, and then it goes down 10% against them. Okay? So it's that fast. When you chase, oftentimes you get punished right away. So if you've ever wondered in your trades, if you take a trade and immediately you're wrong, why that is? It's because either A, you're trading against the trend, or B, because you're chasing. You're the last person into those trades. Okay, so let's try it again. So we have, that resistance line here, that level, that breakout level. That's so you have the idea in your head that okay, that's a failed breakout. Why don't we try it again? Let's play this breakout again. Okay, what do you think happens? This time it works a little bit, right? So you buy the breakout, it pops up, looks great, right? Or does it? Not really. So it moves 6.5% in your favor until it goes back 11%, stopping you out again. This is what happens when you chase. If you constantly chase price, you go into highs, this is what's going to happen. Now, by no means am I advocating never to take momentum trades or breakout trades, but there's a level of understanding that has to happen when you do trade momentum, that there needs to be certain conditions in place for those momentum trades to work, and that you need to manage them in different ways. So my piece of advice, and what I encourage you to do, is to at least have an understanding between trading corrective price action versus always trading momentum or breakouts. You'll see that the blue lines if you buy those levels, you buy breakouts, that would be trading momentum because you're going right into highs. Contrast that with the ovals that are drawn here. That is trading corrective action. So as an example, here if you're buying this breakout, it breaks above these highs, it quickly goes against you. You buy that breakout again, it goes against you. Here, you can extend the line here. This breakout works, right? So it breaks up, then it fades back down again. Here's your line once again, it breaks up, fades back down. Here, it doesn't break out, comes back down. Contrast that with the ovals that are drawn in blue. If you buy in these levels here, that is corrective activity. Corrective activity meaning it's pulled back, it's stopped out other traders, and now you're getting into the trade looking for it to take out the previous pivot highs and for it to go higher. Because if you have the trend right, so this is the determination, is that if you've determined the trend properly, and in this case you've determined the trend is an uptrend, then you want to be buying pullbacks into that uptrend. Instead of chasing price all the time, you want to be looking at pullbacks to get good trade location to then get into that trade. See, so if you buy this pivot, if you buy this corrective structure here, corrective because you've had 1, 2, 3 red bars stopping anyone out who got long in this sequence. When you buy that back, anyone who got short now, if price pops up, they're going to have to cover their short. And anyone who got stopped out here who really wants to get back in is also going to have to rebuy, causing price to pop back up again. So you can see anyone who bought this breakout here, they got frustrated when they got stopped out here. As price got back up, the FOMO kicked back in again. They decided the exact same trade again, and of course it failed once again. Okay, same thing here. You get the corrective activity here. This is corrective activity. It looks a little choppier, but this is when you can actually zoom out a bit. So this is a 12-hour chart. Now I just want to show you a 2-day chart, and that oval that looks choppy here actually looks very, very clean and smooth there. So we're going to talk about multiple time frames later on, but we can use this idea of multiple time frames to try to find a better trade location and to create winning trades. So let's now go on to the next rule. And the next thing we're trying to do is move from uncertainty to clarity. And one of the rules that's going to help that is rule number 3. Don't be a gambler. Now I really like this quote. The quote goes, "Success in business is about staying in business long enough to get lucky." Say it again. Success in business is about staying in business long enough to get lucky. And trading really is like that in many ways. In trading, we're kind of like the casino, right? If you have a system or method that has a positive expectancy or an edge, this doesn't mean you're going to win in every single trade. What it means is that over time, given enough trades, then your positive expectancy should work out. So if you have a good method, then what you should really be seeing with your trades is you're going to have only one of 3 results, only 3 out of these 4 possible results. Number 1, you have a small loser. Number 2, you have a small winner. Or number 3, you have a large winner. What you don't have is you don't have large losers. You get large losers when you start to try to be a gambler. When you start to bet the house, that's when you can become. That's when you can often get these large losers. So rule number 3 says, don't be a gambler. Instead, you want to think like a professional. The biggest difference between a novice trader and a professional one is that the novice traders think of the profits first. They think of all the potential gains first. Whereas the vast majority of professional traders that I know, they consider themselves, or they consider that one of the most important traits of a good trader is to be a risk manager first. We're asking, not how much money can I make on this trade, but what's the potential for loss on this trade? And getting comfortable with that loss first before putting on that trade. So the idea is, how many times can I put a trade on and be wrong and still be in business? For the novice, everything's a binary bet. Either it's going to be a jackpot or they're going to go bust. But trading as a business doesn't work that way. The game is to be in business for a long time. So many new crypto traders or investors unfortunately haven't thought through what their level of loss is going to be. So oftentimes when I've asked new crypto traders what their stop is, they look at me incredulous, like in an incredulous manner. Like, what do you mean by a stop exit? Well, the idea is, how would you know where to exit if the trade's wrong? And a lot of folks, they'll just buy without having an understanding of where to put their stop. So what ends up happening is that they don't work with stops. They work with emotional stops. So whether or not you use fixed stops or mental stops, it's important to have some stop, because if you're just using emotional stops, then you're going to end up closing the trade at the exact wrong point in time. It's when you're unable to handle the loss on the trade. So instead, the practice is to start with your stop first. Where would I exit the trade if the trade is wrong? Because what that's going to actually allow you to do is to create asymmetric risk to reward opportunities. Now, what's an asymmetric opportunity? That's when trade location gives you limited structural risk with much more potential gain. So based upon market structure or price structure, you can hide your stop or place your stop under a level that has some level of protection where price should not break. So that's your thesis. Price should not break below a certain level to keep me in the trade. You're keeping your limit, your risk tight enough so that price, if it was to move in a winning manner, would be a lot more potentially than what you're risking on the trade. That's what makes it a good risk to reward trade. I'll leave you with a quote. We have no control over how much profit we can make, but we have 100% control over the losses we take. And that's what it means to not be a gambler. So let me talk about, let me show you what a recent trade that I took. And it sort of incorporates the last two rules that we talked about. Number one, trading corrective structure. And number two, having good stop location. Or having a stop and using a good stop to afford ourselves an asymmetric risk to reward opportunity. So we showed this chart earlier, but basically it's a chart of Bitcoin on the 2-day time frame. So I'll just quickly explain the price action, and we're going to focus in on the price there in the blue box. Okay? So what we're going to highlight here, I'm highlighting here is the following price sequence. So if you take a look here, we had price go outside bar and up, and here, as soon as you have that outside bar to the downside, this begins to stop out everyone who got long in this sequence. Because what you're looking at here is, if you look at this sequence here, if I draw a little horizontal line right here, that's momentum. Okay, so that's a breakout. See this bar right there? There's a breakout as traders chase this move to the upside. Now when this low gets taken out and this outside bar takes out this prior bar's range, it begins to stop out traders who went long here. Outside, inside bar, so the little red diamonds signify an outside bar. That simply means that price is outside of the previous bar's range, and the blue diamond means it's an inside bar. So this thing goes outside, inside, and outside bar back down again, stopping out everyone who got long and put their stops in this sequence. Goes outside and down, and then the momentum runs out here to the downside. So here's your pullback, then it goes outside, inside, inside. One of my favorite patterns. So you have the volatility expansion, now we have contraction and contraction. And my trade that I took was when price breaks above the high of this pivot right there, that little inside bar high. When price takes out that pivot high, I'm gonna get long, and my stop goes below the low of this inside bar. So this trade incorporates the two things we talked about. getting into trades on corrective activity. So you want to see the traders before you get stopped out, before getting into the trade. Now we're using a good trade location being afforded by by market structure to determine our stop. So my stop's gonna be right there, very, very tight stop, because if it breaks below here, I'm out of the trade, period. It's not supposed to break below that low. If it does, this means this trade is not working properly, with the potential now of going potentially a lot higher. So what happened? There we go. We now know that Bitcoin's now trading close to 11,200, which puts it all the way up over here on the chart. So this trade, when I took the snapshot was up 3.5%, 3.5 R, I mean, but now it's closer to close to 7 R on a 2-day chart. Okay, so here, what makes the trade even better is that there you have your inside bar, and this is the opportunity to add now as momentum's kicked in the trade. This is a great place to add because now you're above the previous ranges. Here you're chasing, but with the understanding that you're already in from lower. Okay. So as you see here, I got another chart. So this thing was, when I took the next snapshot, was up 5.25 R, and now at 11,200, it's closer to 7 plus R. Let's talk about our last rule now. Rule number 4. This is where we move from ambiguity to agility. And how do we become more agile in our trading? With rule number 4. And that is to think like chess, not checkers. And there's our friend, President Donald Trump, playing 3D chess. Thinking chess, not checkers. So let me share with you a quote. Markets will trade to levels that cause the most pain for the greatest number of investors. Have you ever noticed that? The markets just seem to know where to go to cause the most amount of grief for the most amount of traders. So the reality is that traders often take the trade or throw in the towel on a trade at exactly the wrong time. And this is because they lack the proper understanding of time. You see, a proper understanding of time can help you hedge against these major breaks, these short covering rallies, and sort of short-term market movements that can be caused by news or other fundamental events that can push markets past their breaking points. Now, in my opinion, the best traders are those that have a clear understanding between the time frames and can create an accurate mental model that represents the dominant participants across each of the major time frames. And that's a mouthful, but I want you to think about that for a second. The best traders are those folks who are able to construct the mental models that can most accurately represent reality. That is, they understand not just where price is trading at in the moment, but the relationship with price and time across various time frames or time scales. This means they'll know, for instance, what a daily chart looks like and what that resembles on a particular asset. They'll also know what that would look like on a monthly chart, right? So what does Bitcoin look like right now on the daily chart? The price structure. How does it look on the daily or on the monthly chart? What's it look like on the hourly chart? What's it look like on, let's say, a yearly chart? Because if you think about it, trading is like chess, not checkers. In fact, trading is like a multi-dimensional game of chess, where instead of just one single board, there are actually numerous boards in play simultaneously taking place across different time frames. If you're just playing a one board and you think there's only one game going on, then you're missing most of the game. Okay, so sometimes if you don't know why things are happening with the trade, it's because you haven't looked across enough time frames yet. So when I look at a lot of traders' charts, especially those who share their stuff on social media, oftentimes they only show one or two time frames. The daily time frame, maybe an intraday time frame. So either A, their work is incomplete, or B, they're lazy, or C, they're just ignorant of the other time frames that are in play. you really want to have an understanding of price across time. Because going back to this idea of multiple games, price is constantly being contested from the smallest time frame to the largest time frame. So from the lowest time frame you can think of, let's say a sub 1 minute chart, all the way to the largest time frame. Let's say that the 12-month chart or the yearly chart. There's games going across all those charts simultaneously. Now the game ultimately is to control the board, each board, and to advance price in the direction that your side wishes. So the only reason price ends up moving is because of the aggregated outcomes on each board. So if the buyers are more aggressive on every single time frame, from the sub-minute chart to the hourly chart to the daily chart to the weekly chart, so on and so forth, that's what causes price to move. So a question to ask yourself is, when you're doing your analysis, when you're trading, you want to be asking yourself, what do the majority of time frame participants see? Right? So you need to zoom out a bit and not look at just the charts that you're looking at, but you want to have a sort of forest through the trees approach. You want to be using multiple time frames. This is how you start to play chess, not checkers. So what I advocate for swing traders is at least to be looking at the quarterly, the monthly, the weekly, the daily, and if you're gonna trade intraday, then get down to the 64-hour and 12-hour charts to get those higher time frame perspectives. Another question you want to ask is, where are we trading relative to the open of these different time frames? Because if you're trading below the open of, let's say, the daily chart, that means price is going to be red, right? It's going to be a red day. If you're an intraday trader and price is trading below the daily open, you're going to want to know that, because any day, any traders who are looking at the daily chart, it's going to look like a red day to them. So if you're buying on a day that looks red, for traders who look at the daily chart, then know that you're going to have natural sellers there. They're going to be naturally biased because the day is red. So play that out across different time frames. What if it was a red day, it's a red week, it's a red month, and it's a red quarter, and you're trying to buy something on a lower time frame chart? Recognize that the majority of time frame participants at that time are seeing the charts as being red. If you're buying something at that point, you're fighting all these natural sellers that are there due to the different time frames that are currently aligned to the downside. So you want to know where we're trading relative to those opens. What ends up happening a lot of times is that you may have conflicted time frames, and this is when you oftentimes get chop or noise. Being able to see that takes away some of the ambiguity of trading, and it gives you the ability to be more responsive, because now you have an understanding of price across time. This is when you can get more selective with your trading and when not to get involved, which is just important as getting involved or knowing when to get involved. So, as a recommendation, if you're just a swing trader, I'd always recommend having at least these 4 time frames up to be able to see, the forest through the trees. So, the 3-month chart, or the quarterly, the monthly, the weekly, the daily. If you look at the Bitcoin chart right now, you can see it clearly. Green, so on the right-hand side, on the bottom quadrant, green on the quarter, green on the month, green on the week, green on the day. Is that aligned? Is time frame aligned? Yes, it is. So do you want to be looking for shorts? Not necessarily. Right? The easier trade right now is to go long. So having that understanding will allow you to create simple filters for yourself to know when to go long, when to go short, or when to do nothing. So let me give a quick case study of my trade that I put on back in April, where I kind of incorporated all these different elements that we've been talking about in this presentation. So back on the 1st of April, I put on the blog and on Twitter that I was back in a Bitcoin. I was back in a Bitcoin on this particular setup right there. So I'm gonna now I'm going to now deconstruct the trade, starting with the big picture first, and then getting to the actual execution of that trade. Okay, so big picture. Who here ever looks, at the 12-month chart? Okay, so if you don't, it's actually a very interesting chart. Now Bitcoin's only 7 years old, so you don't have that many bars with Bitcoin. Some of these altcoins are even less than 7 years old. Most of them are. So you're going to have even fewer bars, but still worthwhile to look at every now and then. You don't have to look at the chart very often, as it really only updates, meaningfully. The bar only changes once a year. So going into 2019, this is what we saw as traders. 2017, we had that huge run up to the 20,000 mark, and then we had that steep pullback. We had an 80% pullback. But even with that pullback, price was still inside of 2017's range. So even with that deep pullback here, it was still an inside bar. Now contrast this and compare that with that previous inside bar back here. Exact same phenomenon. Back in 2013, we had that big run up, then it sold off 90+%, but even then it was still an inside bar, right? It didn't go back to zero, so it was still an inside bar. Then it went inside before finally breaking back to the upside. Here we have an inside bar after that large range bar. Now going into 2019, here's my thought process. Price was only going to do one of four things, because price can only ever do one of four things. In 2019, price was either going to go down, so inside bar then down. It was going to go inside bar and then another inside bar, meaning it gets stuck in this inside bar like it happened here. It was going to go inside bar and up, or, and it can still do this, it might go inside bar, outside bar, meaning it takes out that side of the range and takes out that side of the range, or vice versa, that side first and then that side. So knowing what price can do really helps, because it can only ever do one of four things. So that was what I was prepared to do, or to see, with the Bitcoin 12-month chart. Now on the 3-month chart, it looks like this. So going into the end of 2018, we had an inside bar in down condition. Now, if the buyers can break it above this bar's high, I call that an inside bar reversal, because then the buyers have reversed this sell condition, and they're going to go after the one who got short in that sequence, meaning they take out that pivot, they're going to go after that pivot. Even better, what we saw here was that we had inside bar and down, then the first quarter of Q1 in 2019, it actually went inside bar again. So we have talked about it already, how tight that range was in that first quarter of 2019. So as that first quarter of 2019 closed, that was the opportunity, an inside bar reversal, because here the sellers could no longer force price down any longer. It was stuck here at the bottom. As soon as buyers can take out that bar's high, they can then potentially go after that pivot high, then that pivot high, then that pivot high, because we know where the stops are going to be. So fast forward now to the weekly chart. We've seen how that, we drew that blue box before, and how choppy that was, right? It's very hard to trade that stuff because it's very tight and choppy. So you can zoom out and look at the monthly chart, and that's what I did. Looking at the monthly chart, this is what we see as a sequence. Inside bar, outside bar, inside bar. So all happening in that tight blue box. Inside bar meaning the sellers could no longer push price down any further on that monthly chart. Outside bar, that means the lows here got taken out to the downside. The buyer stepped in, taking out both sides of the range. Then, before it can go any higher, there was consolidation for another full month. So anyone who wanted this thing to take off had to wait an extra month. So the entry was the break of this inside bar's high, and the stop was the low of that inside bar low. So this trade uses all three principles that we talked about already. Using first corrective structure to get into the trade. So we're not buying highs here. We're first waiting people get stopped out. We're getting people stopped out in that outside bar as well, as it takes out the low of here and stops out anyone who got short. We have a very, very tight risk to reward. So the risk is the low of that inside bar, with the potential being that pivot high, and that pivot high. And lastly, the understanding of time. Okay, so we now know what the yearly chart looks like. We know what the quarterly chart looks like. We know what the monthly chart looks like. We know what the weekly chart looks like. We don't have to draw into the day because it's choppy. We saw what the weekly looked like. It was just as choppy as that. If you want to hide some of that noise, you go to a higher time frame. Now, one last thing, this little blue line there, basically what that is the quarterly open. This simply shows you where did the quarter open. So, right there, this shows you that anyone looking at the 3-month chart sees the quarter as being green. Okay, so this means that once again is making sure there are natural buyers stepping in when you want to buy. So price remains above the quarterly open there, and that trigger pops the consolidation. So we buy there at 42.10. The stop goes below that inside bar low, and that trade works out to over a 13-hour trade. Now price is up here as at 11,000 something, so now that's more like a 15, 16-hour trade. So did I hold all of it all the way back here? No, I did take profits. I took profits on the sequence here. I took profits there, as that was the pivot that actually some there, and I'm moving my trailing stops up now, as I still have a portion to trail, because we're going after those pivots. We know where people have their stops. All right, so putting it all together, as I said already. Number 1, entry on corrective structure. Number 2, stop first. Looking at where we're going to put our stop first, right? Below that inside bar to create that asymmetric risk to reward. And finally, using the multi-time frame analysis to help us play chess, not checkers. We're thinking multi-dimensionally here across time, not just one single time frame. So in summary, in this presentation, I talked about the challenges of VUCA and how in cryptocurrencies we have volatility, uncertainty, complexity, and ambiguity in spades. I talked about how to solve the VUCA challenge through the understanding of a vision, understanding, certainty, and agility. And finally, I shared 4 road rules to help with your trading. And those rules were: number 1, know the landscape. Number 2, don't chase. Number 3, don't be a gambler. Number 4, think chess, not checkers. I hope you enjoyed today's presentation. If you have any questions, any comments, please feel free to leave them in the comment section.